intervention in the crisis by advanced economies, Europe and US in particular, has no doubt been helpful in restraining economic contraction and instability. But nevertheless, the recent measures that are being taken, particularly in the United States, are not helping US in promoting a solid and rigorous growth, but undermining stability in developing countries. And that is a problem that could prove to be very costly in the near future. And the speculative capital flows are the main conduits. The conduits, speculative capital flows, are also the ones that are playing an important role in commodity instability. These flows are reversible. We know it from the history. I will go through the previous post-war boom and bust cycles in capital flows. And when they are reversed, the damage they can cause can be very serious. And that's why we need to manage them in good times. That is when they're coming in, as we know from various crises, that it's very difficult to manage capital when they're going out. So, if we look back the post-war period, until 1970, developing countries did not receive much private capital, and whatever there was came in the form of foreign direct investment. The first boom started in the mid-70s with the booming commodity prices, OPEC surplus and US deficits, and ended with a bust which caused a debt crisis in Latin America. This is the boom that I'm talking about, which ended with a bust in the early 1980s, which cost Latin America a decade. The second boom started in the early 1990s and ended with the crisis in Asia and many other countries. This is the second boom in capital flows and ending after the Asian crisis. The third boom in private capital flows to developing countries started in the early 2000s. The factors that were driving the subprime bubble in the United States were also driving the capital flows to developing countries. And this boom ended after the subprime crisis. This was the peak of 2007, ended in September 2008 with the collapse of Lehman Brothers. But it was short-lived compared to other busts, and soon afterwards we had the fourth boom in private capital flows to developing countries starting in mid-2009, and this boom is starting and continuing with full force now. These cycles naturally differ in terms of composition of capital going in, their destination, their effects, but they have also some common features. All these booms started with under conditions of rapid expansion of international liquidity. When we talk about international liquidity, we often mean dollars, because it's the key central reserve asset. The 70s was due to petrodollars and the US deficits. It gave rise to commodity boom, low interest rates. The 90s, again, low interest rate in the US after the deflation in the early 90s, and also in Japan. And again, 2000 is a historically low interest rate in the United States, which gave rise to the subprime bubble, which was a search for yield, given that equity markets were stagnant and the interest rates were very low. Banks, investors started looking for yield. Subprime was one aspect of it, but capital flows Another, because developing countries were promising much higher return than ordinary safe lending in the United States. And also, the third boom started at the time when Japan also had almost zero interest rate in 2000, 2001, and even the European Central Bank set down interest rates to very low levels. So these common features, low interest rate and rapid expansion of dollar liquidity, I think applies to all the cycles we saw in the post-war period. And it applies to the current cycle as well. When we look at the busts, we see tighter global financial conditions, higher interest rates, and stronger dollar. This is the pattern. Recipient countries also show some deterioration in their macro conditions, particularly in current account positions, but this is not because of changes in the policies in the countries, but because of the effects of capital inflows themselves. Now, we know these general features of booms and busts, but we don't know when they occur. It's very difficult to predict, to predict the timing of a crisis or what the factors that trigger them, even when one can identify with a reasonable degree of confidence that the current situation that are driving such capital flows are not sustainable, as I do now. Now, the capital flows to developing countries started around to recover after the Asian crisis and a number of crises in Argentina, Russia, in my own country, around 2000 to 2003. And it continued until September 2008, despite the subprime crisis. And the reason was that the crisis was taken very lightly. There was still plenty of liquidity in the market. Interest rates were low. Developing countries were expected to decouple from the crisis. So despite the fact that the crisis was known, the capital flows continued going into developing countries until the collapse of Lehman Brothers. In fact, it's very interesting that it's the time that the IMF was upgrading its projections for global growth in the summer of 2008, when capital flows were going into developing countries, and the same moment as the Lehman Brothers collapse and other financial institutions went into trouble, IMF started downgrading its growth projections. There was a sharp downturn in capital flows to developing countries. But this is short-lived. In mid-2009, where a new boom started. I think it took about 6 to 8 months. It's very difficult to tell the exact timing of turning points, for 4 reasons. First, the quantitative easing that the US and Europe took did not actually translate into credit expansion in these countries, because banks were not willing to lend to firms and households. Households were not then willing to borrow because of debt overhang in the United States, and the firms are not willing to invest so much when you have a very sluggish recovery. So the quantitative easing, new monetary expansion, which was a response of a crisis which was brought by debt accumulation and liquidity expansion, has not actually accelerated growth in the US. Therefore, money started looking for yield once again. Secondly, interest rate differentials moved in favor of developing economies, developing and emerging economies, even though they lower as well as the average advanced economies. Interest rates differentials were clearly in favor of developing economies, which created a lot of opportunities for carry trade. Third, and this is important, I think this crisis has shifted risk perceptions against industrial countries, particularly after the sovereign debt problems in Europe and the concerns with rising government deficits and debt in the United States. For the first time, North-South risk spread shrunk, not because of falling risk in the North, but rising risk in the South. And this makes it, in fact, more attractive to invest in the developing countries. And finally, with the prospect of better growth in the South, particularly in China and other Asian countries, clearly equity windfalls, capital gain prospects were in favor of developing countries. So soon after the downturn, the sharp downturn we saw here, we have a very rapid upturn, and in fact, according to the latest projections, the current capital flows are more or less very close to the levels of the peak in 2007. Now, these four factors that I mentioned are likely to persist over the near future. Okay, and therefore, I expect, short of a major turmoil, capital flows to continue for a while. Now, this current boom, as well as the boom before the Lehman collapse, differ from the previous cycles in many respects. Now we see greater synchronization among developing countries in the way they receive capital flows and in the way capital exit from these. In the previous booms, you had Latin America, then moving to Asia and region focus. Today we have greater synchronization. Secondly, in previous capital flows, booms, developing countries were running deficits and they were using capital flows to finance deficits. Now they are running, from the early 2000s onwards, surpluses against advanced economies. And most countries which have been receiving capital inflows do not need them. This money is going into reserve accumulation, not into financing external deficit. And that's an important difference. Third, the amounts involved are much larger, both in real terms as in proportion of GDP. Not only the amount of inflows, but the amount of swing between inflow and outflow is larger. I think the swing in 2008 was around 4% of GDP of developing countries compared to 2.5% in the swing after the Asian crisis. The fourth factor, which is again important, there is a two-way traffic today between developed countries and developing countries. In the previous cycles, particularly until the second half of the 1990s, there was hardly any official legal outflows from developing countries. Most outflows were in the form of illegal capital flight. But now we see a major outflow from developing countries. I invite you to look at chart 3 on page 12 of my paper, where it looks like a ship. The top one is inflows, bottom one outflows. And most of the outflows from developing countries, that is investment or acquisition of assets by the residents of developing countries, are in portfolio investment. There is some FDI outflows from developing countries, that is, the residents of developing countries invest in real assets abroad, but portfolio investment abroad, that is in the equity markets of developed countries or in the bond markets of developing countries, are far more than the FDI outflows from developing countries. Fifth feature, there is increased capital flows among developing countries. This is also a new feature. Most of it is in FDI and most of it is regional. Sixth, this is an important feature which actually alters the nature of vulnerability of developing countries to boom-bust cycles. Now, a much larger proportion of external liabilities of developing countries are denominated in their own currencies. 70% I estimate, of the external liabilities of developing countries are in the forms of equities or bonds in domestic currencies, and this proportion was 40% during the Asian crisis. Growth of carry trade has become important, and this is linked to the previous feature, because carry trade means that international investors come into developing countries and invest into local currency fixed income instruments. And finally, we see a massive increase in the presence of foreigners in the financial markets of developing countries. I'm not just talking about banks here, I'm also talking about equity markets. In several countries, the share of non-residents in the actively traded equity markets exceed the share of residents of the countries. Now, what's wrong with all these? What's wrong with the boom-bust cycles? What impact do they have? From history, we know that there are three areas where boom-bust cycles in capital flows can damage developing countries. First, you can have, if the capital flows support unsustainable exchange rates and current account positions. You appreciate your currency, you run growing current account deficits, and you finance with this, with the incoming money. And when money stops coming in, you're in trouble. You're in trouble, you have to make a very severe balance of payments adjustment. Now, if you look at the exchange rate of developing countries, this is an average of 30 most important emerging markets and developing countries. From 2004 onwards, you see a strong appreciation of the currencies, this is the average, followed by a sharp decline during the Lehman collapse when capital went out, and followed by, again, a rapid recovery and appreciation again. So there was a period of sharp declines in the currencies, but this was quite short-lived, followed by immediate upturn, and many developing countries are appreciating their currencies. But the thing that is worrying is that deficit countries are appreciating more than surplus countries. I'm talking about India, Brazil, Turkey, my own country, South Africa. They are deficit countries, and they are appreciating faster than surplus countries, China, Korea, and many countries in Southeast Asia. I have a big chart here. You can see the top one is exchange rate, the bottom one is current account, the zero is the deficit. You see, take for instance, India, currency is up, current account deficit is rising, negative. The same with respect to Brazil. When the gap is opening, the sign is worrisome. Currency is going up, deficit is going up too. Deficit going up, negative coming up, down. And the same with Turkey, and the same with South Africa. Other countries which do not have deficit, which have surpluses, do not experience rapid appreciation. And in some cases, appreciation for these countries could be quite benign. Second problem is, during the inflows, there is a build-up of external liabilities by the private sector in foreign currencies. This is what we call liability dollarization. If this is short-term, when money goes out, as we saw in Thailand, in other Asian countries, the private sector faces serious problems, and therefore you have widespread defaults. This is what we call currency and maturity mismatches in balance sheets. This is being happening, but to a much less degree than it had happened before the Asian crisis. So we have currency mismatches in several countries. My paper explains which ones, but the mismatches are not that important compared to the past situation. And third feature, which is becoming more and more prominent, is that our asset markets go up and down with the asset markets in Europe and United States because of increased presence of foreigners in the asset markets of the European countries. And this chart is very interesting, that you see the dark one is capital flows, and the pink one is the equity market indices for 30 developing countries, emerging markets. You see how close they move together. This is the 2007 boom, peak. This is the Lehman collapse, and this is the post-Lehman recovery. This means that when the Wall Street sneezes, we may catch more than cold now. We may catch pneumonia because of this close connection between equity markets in the European countries and equity markets in the West, as a result of increased foreign presence. Now, all these lines, of course, can go the other way once the capital flow started exiting. But perhaps more interesting feature of the recent cycle is that this cycle is actually associated with a similar cycle in commodity prices. As you know, commodity prices started to rise in 2003 and accelerated further in 2006. And like capital flows to developing countries, kept up in the summer of 2008. You will recall that oil going up to $150. And I asked myself at the time, how is it that in the middle of a subprime crisis, we have a boom in commodity prices? The food crisis came right up in the middle of subprime crisis. And I actually gave a sort of a presentation on it in Palais with ESCA. And subsequent events show that my hunch, my feeling at the time proved to be correct. Now, commodity prices boom in the middle of a subprime crisis, just as the same way the capital flows to developing countries boom in the middle of subprime crisis, until Lehman collapsed. But commodity prices also collapsed after Lehman collapsed. But more interestingly, the collapse in commodity prices were also short-lived, like collapsing capital flows. This is a very interesting chart. The continuous line is primary commodity prices. The dotted line is the capital flows to developing countries. You can see they're following it very closely and peaking the same time, collapsing the same time, and recovering the same time. Now we have another recovery. Why? I think what we saw in the past decade, I'm talking about the years 2000, increased financialization of commodity markets. Commodities have started to act as a special asset class in the portfolio of international investors, and has become an attraction for speculation to benefit from changes in prices over time. For instance, the investment in index trading by investment fund rose from 13 billion to 320 billion in 2007. And the number of commodity derivatives increased from 13 million to 66 billion in the same period. This is unprecedented in the extent to which commodity investment and commodity speculation by people who have no real use for these commodities started and deepened. But what is interesting is that commodity prices, capital flows to developing countries, and dollar all moved in tandem. As you know, after the subprime crisis in 2008, there was a flight to safety. At this point, the dollar appreciated sharply against most other currencies at the time as capital flows to developing countries collapsed, and at the same time, commodity prices went up. So what happened was actually, just as people got out of commodities, and as they got out of developing countries, they went into safe haven of the US treasuries. So we have an inverse relation between the strength of the dollar and commodity prices in the cycle that started in the early 2003. That means that if this pattern continues to hold, any downturn in the capital flows in developing countries is likely to be associated with a downturn in commodity prices and a strengthening of the United States dollar. Now, how will the boom end? How might it end? I mentioned already the common factors which are driving the current boom, and I expect them to last for a while. I see basically three scenarios under which the current boom in commodity prices and capital flows can end. An abrupt monetary tightening in the United States. Now, as you know, the United States is under the conditions of deflation. And Mr. Bernanke is trying to create inflation in asset and product markets in the United States so that consumers can get out of debt and there will be some demand pressure which will push the economy forward. But it is not very successful. Rather than creating inflation in the US market, asset and product markets, US Fed is creating inflation in international commodity markets. And US quantitative easing, monetary policy is creating inflation in the asset markets of emerging economies like China, India, and Brazil, and others. Now, of course, if this trend continues, commodity boom will continue. Commodity speculation will continue. Coming on top of political problems in the Middle East, with the oil prices going up and up, US can find itself in the same situation as it did in the late 1970s, when Mr. Volcker came and suddenly tightened monetary policy, which created recession in the United States and a debt crisis in Latin America. This is a scenario which should not be underestimated. That is, current boom in commodity prices, strong growth in China as #1 importer of commodities, political difficulties in oil exporting countries, together can force the US to tighten monetary policy before the economy is fully out of the woods, fully out of the recession, and that create problems for developing countries, just in the way it did in the 1980s. The second scenario doesn't belong to me. It was discussed in Davos earlier this year by advisory, the private company, Oliver Wyman, is in the text. According to this, the main factor driving commodity prices is excessive liquidity, but on the real side, growth in China. China has been purchasing commodities a lot, and in fact, this is one of the reasons why China is now running trade deficit, accumulating. But Chinese economy is overheating. Last year growth was 10.3%, and government is worried. There's a property bubble in China. And China has already increased the interest rate 3 times, and reserve requirements twice. And according to some news, China is now targeting a growth of 7% for 2012. Now, I'm not sure this is figure, but in any case, the scenario goes like this. If growth in China slows down considerably, either as a result of monetary tightening or stagnant export markets abroad, then the commodity markets can slow down and commodity prices can make a downturn. And this could trigger a massive outflow from commodity futures and bring in an end to the commodity bubble and a sharp turn like we saw in 2008. This will make lending to commodity-rich economies unviable, create a pessimism, extreme risk aversion, and trigger capital outflows from developing countries. That is the second scenario. The third scenario is a common one, which we saw elsewhere, which we saw many places in the 1990s, which is current policies and capital flows can eventually create a crisis in a major emerging economy. Whether it's Brazil, whether it's India, whether it's this, I'm not predicting it. As a result of widening deficits, so suddenly international lenders, as they did in Thailand, saying that, sorry gentlemen, we're not lending you anymore, your deficit going up, your currency is overvalued, they pull out, contagion across the developing world, that can happen. But this depends very much how these countries manage their current economy. Or a domestic financial crisis in places like China or Brazil, where we have massive expansion of credit, can lead to, again, a crisis in downturn. So there are basically 3 ways of that I can see this crisis ending. I'm not going to put probabilities on which one, but as I said, if oil prices keep strengthening considerably, I see this boom ending in much the same way as the 70s boom ended. Which countries are most vulnerable? The countries most vulnerable are those which are enjoying the twin benefits of the boom in the world economy. That is the commodity exporters. It's quite remarkable that countries like Brazil or South Africa, which are main commodity exporters, are running growing current account deficit at the time of commodity bonanza, appreciating their currencies. So when the downturn comes, if and when downturn comes, they will be hit twice. One in the falling commodity prices, twice in the falling capital inflows. In fact, all this reminds me that Mexico was the first country that went into crisis in 1982. And in fact, Mexico benefited twice during this 1970s expansion. Once as an oil exporter, and secondly, as a massive influx of foreign money. Of course, I'm not predicting that Brazil will be the first one, and I'm saying that this is a country which is running growing deficit under a commodity bonanza should really look at its policies very, very carefully. So what to do? What to do that we should manage the capital inflows properly in order to stop inflows generating fragilities, deficits, appreciations, bubbles, mismatches, so that when capital exits, we don't get hurt. There are basically 3 ways of dealing with it. One is currency market intervention. Central bank goes in, buys the currency coming into the country, issues domestic currency against that, puts the dollars into reserves, and sterilizes the effect of this operation on domestic liquidity by issuing government papers or central bank papers. This is called sterilized intervention. Most Asian countries did it, they still do it. Some Latin American countries do it. The countries which do not practice inflation targeting usually do it. Argentina is one of them. Other countries don't do it. Now, certainly, this can prevent appreciation because you're not allowing the excess foreign exchange going into interbank market, you're absorbing it into central bank. So you can prevent appreciation, you can prevent current account worsening. But full sterilization is very difficult. In some countries, with close control over the banking system can do it well, but it's usually difficult, which means that domestic liquidity can expand, creating inflation in asset or product markets. Secondly, it's costly. What you can earn today on US Treasuries is no more than 3%, and the interest on government debt in developing countries are in the range of double-digit figures. So you're running a lot of what we call carry cost. You're buying reserves, you're buying US Treasuries, which bring you 3%. Against that, you issue 6, 7, 8, 12% interest government paper. Moreover, interventions do not prevent mismatches in private balance sheets. As a private sector, I can be borrowing, bringing the money, you're buying it from me, putting it in reserves. I have a currency mismatch, but you are providing me a public insurance for my private risk. Intervention to sterilize the effects of capital inflows is effectively intervention and reserve accumulation is a public insurance against private risk. And finally, it doesn't really make sense. Why? Because money is coming in. You're not making up any use of it, productive use of it, putting it on the side on low-yielding assets as an insurance against the exit of the very same money. It doesn't make sense. So, second option which countries use in Asia, some using today, if money is coming in, you can allow your residents to take it out. Allow residents, even encourage them to take the money out, make investment. What we call liberalization of outward capital movement, acquisition of foreign assets. Now, of course, this may be better than intervention and reserve accumulation, particularly if you're encouraging FDI abroad, that your companies are investing abroad. China did it, India did it. But the problem is that you have a maturity mismatch. FDI is a long-term asset. Money coming in is a short-term. And you have, therefore, a leveraged international operation. When you invest abroad with your own money, as China is doing, it's one thing. When you invest borrowed money, as India is doing, it's another thing. It does not prevent maturity mismatches, currency mismatches in private balance sheet. Why? I may be investing, you may be borrowing. So you have still the problem of solvency at times of inflows. But most importantly, this could be a one-way traffic. In good times, you let the money go out. In bad times, there's no guarantee that they will bring that money back. So reserve accumulation is a self-insurance by the public sector. But private sector accumulation of foreign assets abroad is not a self-insurance for the country as a whole. In fact, we saw that during the Lehman collapse, we had a lot of money from residents going out as the foreigners were pulling out of these markets. And finally, capital controls. We have had some suggestion that not only developing countries receiving capital flows, but also source countries like the US should restrict capital outflows. That is, restriction on outflows from the US. Now, it's argued that this could be in the interest of the US. In fact, US used interest equalization tax in the 60s to stop capital flight, capital leaving the United States. But at the time, this was good for the US because US has a fixed convertibility with the gold. So any money going out of the US, dollars, will mean depletion of gold reserve, demand over gold reserve. Without the benefits of devaluation of the US currency because it was fixed. But today, this is not the case. One, US is benefiting from the pressures that policy is putting on other currencies, effectively meaning competitive valuation for the US. Secondly, US financial institutions are making a killing. I'm talking about carry trade. When you borrow almost at zero rate in the United States and put into government paper in India or Korea or elsewhere at 8–10%, at the time when the exchange rate of the rupee or won appreciated, you're making a lot of profit. And the US is not going to stop these profits from being made. So the burden will fall on the European countries. But control of capital flows at the source countries should be a matter of concern to the European countries, and that should call for a multilateral arrangement. Now, what sort of control? After the Asian crisis, a myth was promoted that if you have a strong prudential regulations, capital flows are harmless. In fact, Asia was blamed for not having strong prudential regulations. Of course, prudential regulations for the banking system are important if you extend properly to deal with the exposure in foreign currencies. But as I already mentioned, a very large proportion of capital inflows today are not intermediated by the banking system. 30% is only going through the banking system, 70% going directly into the equity market, directly into the bond market, or borrowing by non-bank corporations from abroad. So you need to go beyond the banking regulation. And countries are often not willing to do it. What we've seen recently is an imposition of various taxes on entry of foreign money. And one of the most publicized such imposition was the Brazilian tax on the entry of foreign money, raised from 2% to 6%. These taxes don't work. I explained this in my paper. Why? Because the kind of rates they're imposing are totally ineffective. When the interest rate is 12% and currency is appreciating by 10–15% a month, a 4% tax will not make much dent in arbitrage profits. You need much higher taxes. And secondly, most of these capital control have exceptions. Well, FDI is accepted, but FDI has the same effect on the currency as any other capital. Some borrowing are accepted. And in fact, according to some studies, Brazilian capital controls, the tax has not worked. And in fact, I saw it last night on the news that Brazil is considering new measures. So you need widespread, effective, permanent control over capital flows on all fronts. Are they effective? Yes. Fully? No. But enough if it's applied vigorously. So what I conclude? I have about 3–4 policy conclusions from this. First of all, developing countries need to manage capital flows much better than they have been managing. Some are doing well. Some Asian countries doing quite well. But even accumulation of reserves will not prevent serious impact of outflows. So we need to manage them quite well. We should not allow current account to get our hand. Our former Secretary General, late Prebish, once advised European countries that during the boom in commodity markets, you should run surpluses and put them aside for rainy days. You should not be tempted to appreciate currencies. You should not be tempted to run deficits because you can borrow more now. But the commodity markets, just as today, markets for capital are subject to up and down, and a precautionary measure for the commodity economy is to run surplus at times of bonanza and reserve, puts as reserve. These reserves are quite different from reserves built from capital flows because it's not borrowed reserves, these are earned reserves. Reserves earned from your current account surpluses. So you should put it. So therefore, I would say commodity exporting developing countries should take another look at their exchange rate policies, at their policy with respect to capital flows. Second, as I mentioned, developing countries are not in need of external financing from advanced economies anymore. Collectively, they've been running surpluses, and these are structural surpluses, not going to disappear, even if China and other Asians make some adjustment. But there are several developing countries which are running structural deficits, particularly in Africa, in Southeast Asia, elsewhere, in Latin America. So we need to find a way of recycling surpluses from surplus developing countries to deficit developing countries, stable systems without going through the Wall Street of the city. Today, Vietnam goes through the Wall Street of the city in order to transfer the surplus of other Asian countries into Vietnam because the US is not generating any surplus. So why do we spend all that money? At one point, I think I calculated in one of my papers that if this could happen, developing countries simply recycling from surplus to deficit developing countries directly could save up to $50 billion per annum. The second area of reform is the international financial architecture to reduce the systemic instability. US would not have been able to follow these policies if the dollar was not the central reserve currency. Why? You cannot do it. You cannot do it. You cannot go and expend dollars and have a benign neglect of the exchange rate of the dollar. So we need to look at the reserve system. We need to look at the exchange rate system. Competitive devaluations. We need to see what effective surveillance we can bring. We need to look at the regulation of international capital flows. And finally, this is not on the agenda of anybody, whether it's IMF or G20, we should put the regulation of commodities trading on the table. I think this is particularly, I find, important for UNCTAD to emphasize that this commodity instability has been increasingly dominated by the commodity futures. I'm not denying